Sanibonani. We are now in lesson 2 part 4, where we are going to discuss in more detail the reasons why the stock market prices move up and down on a daily basis. I am your teacher and mentor, Mntom'nyama. So what causes market prices to fluctuate up and down? For example, today the price of the stock would be, say, 200 rands, and the next day the very same stock would be selling at 220 rands per share. What caused the price of the share to move up? It's like going to a food supermarket to buy a loaf of bread. Today you buy the bread for 10 rands. You come back the next day to the very same supermarket and you find the price of bread has risen to 15 rands. What happened? In the previous lesson, we learned that stock market prices are driven by supply and demand. But to go a little bit deeper, we asked the question, what is the driving force behind supply and demand? Why do people buy more of a particular stock today and thus cause the price of the stock to go up? And then the next day, week or month, more people sell more of that stock, causing the price to go down. There are three primary reasons, and let's go through each one of them. The first driving force is emotions. In the short term, as in daily, weekly, monthly, or even up to a year, stock prices are not driven up or down by logical decisions made by investors. In most cases, prices are driven by people's emotions. In the previous lesson, we identified these emotions as fear and greed. When people become scared due to negative news, they tend to become emotional and irrational at the same time. The fear of losing money causes them to panic and start selling shares of companies they invested in. They sometimes do this foolish thing even though, number one, the negative news or event has got nothing to do with the businesses they are holding. Number two, the businesses they are selling remain great businesses despite negative sentiment. And this is a foolish thing to do. And the more people sell, which is at a loss, by the way, the lower the price of the stock, causing even more people to panic sell, which drives prices even lower. This carries on until there are no more people left to sell. And when that happens, we have reached the bottom of the downtrend. Greed, on the other hand, has the opposite effect. When people get caught up in a hype about a particular stock and there is an air of optimism in the news about that company, people tend to flock to that stock and start buying in large numbers. This causes the price of the stock to go up. As the price of the stock goes up, more people jump in because they don't want to be left out. This is called FOMO, fear of missing out. And so the trend continues up, up and away until the bubble bursts at the top. I will give you an extreme example. Remember 2020 COVID-19 market crash? When news of the virus came out, it was all doom and gloom. People thought it was the end of the world. Big institutions and retail investors alike started selling their shares in panic. Stock prices of great businesses were not spared. This caused the S&P 500 to drop from all-time highs to all-time lows, all due to fear and negative sentiment perpetuated by the media. But after a while, when people learned more about the virus, they realized that actually it is not the end of the world, and they started buying up companies on the cheap, and the stock market recovered back up again, as you can see from this trend. The important lesson here is, as investors, we must not succumb to emotions. We must base our decisions on facts and figures, not emotions. The second driving force is algorithmic trading or algo trading. This is high-frequency trading that is done by robots. It is estimated that up to 70% of transactions that occur on a daily basis are done by robots or machines. These robots buy and sell in a split second based on price action at that moment and not based on business value and fundamentals. This high-frequency buying and selling can create big swings in market prices on a daily basis. This is how it works. When the price of a stock drops to a certain level, These robots are programmed to set the stock in order to cut losses on a losing trade or in order to short the market or that stock, causing the price to drop even sharper. On the other hand, when the market or stock goes up, these robots buy in a fraction of a second to catch the upward momentum of the price, and thus causing the price to rise even faster and higher. By doing this, these robots cause price extremes or volatility in the markets. Even though a lot of people complain about these robots, as informed investors, we love them. Why? Because the volatility they create allows us to buy great businesses at big discounts due to the temporary mispricing of a great stock by a mathematical equation. The third driving force is market maker manipulation. Price movement in the market can also be caused by market maker manipulation. These are big institutions who, in conjunction with certain media, release news that influence buying and selling decisions of retail investors. Now, because these big institutions, such as hedge funds and banks, have deep pockets, they would deliberately force the price of the stock down, which is called short selling. When inexperienced investors see a sharp drop in price of the stock, they will panic and start selling that stock at a much lower price than they bought it, and thus lose money in the process. And who is on the other side buying up all the cheap shares sold by the retail investors? You guessed it right, the market makers. Once the market makers have accumulated enough shares on the cheap, they will then drive the price up again. This will entice retail investors to jump in as the stock prices move even higher. When the price is high enough, the market makers sell at big profits. And who do they sell to? They sell to the retail investors buying high because they still think that the price will continue to go up. So the end result of this manipulation is this. The retail investor ends up buying high at a premium, like over here, and selling low at a loss, like over here. And this is a recipe for losing money. The market makers, on the other hand, end up buying low over here, which is cheap. Yeah? They buy the shares when they are cheap. And they sell high at big profits, like over here, and over here. And this is a recipe for making money. So the retail investors end up losing money, whilst the market maker manipulators end up making lots of money at the expense of retail investors. Do you guys see how the game is played? But again, as investors who are well informed, we are not troubled by the manipulation that happens in the markets. We just invest alongside the market makers. Because at the end of the day, it does not matter who is doing what in the markets. We focus on taking advantage of these factors that cause a temporary mispricing of a great business. We buy these businesses at big discounts and we hold them for the long run, which is 3 to 5 years. It is just that simple. I hope you guys got it.